Okay, I think we'll make a start. First, I'd like to welcome today's attendees. We've been overwhelmed with the take-up. It's great you can all join us for today's webinar. My name's Victoria McDonnell. I'm the Marketing Manager at Brookson, who, for those that don't know, have been providing specialist accountancy services for contractors for the past 20 years or so. I'll be the webinar host today. I'm joined by my colleague Matt Fryer, who is the Senior Compliance Manager at Brookson, and Business Associate Tom Wynne, who's from Kingsbridge Contractor Insurance. The webinar, which covers risks and rewards of limited company working, will run for around 45 minutes, and we're going to try and keep to that time as much as we possibly can for everybody. I would encourage you to submit questions throughout the presentation. You can do this via the box on the right hand side of your screens, and we'll try and take some questions where appropriate during the presentation. We do also have some time worked in at the end of the slides to take some questions then if time allows, and anything we don't get round to answering, I'll look to produce an FAQ style document that we can send out to attendees, covering all the key points that are raised and some of the common questions that we get asked. Okay, so I'll now hand you over to the presenters, Matt and Tom, and we'll take it from there.
Okay, so just by way of agenda, there's 4 key areas we're going to discuss on this webinar, and we'll use any time left at the end to pick up questions that you are hopefully dropping in as we go. So we're going to start with a brief overview. The majority of people on this call are limited company contractors, so just an overview as to why you've made that choice, and the reasons why. It's a growing, ever more popular way of working. Then we're going to discuss some financials, predominantly focusing around tax planning opportunities available to limited company contractors. Moving to risk management, and I think 2 key areas are around IR35, so I'll touch on that and what changes we may be seeing. And then Tom's going to come back in and discuss insurance. And then finally, we're just going to do an overview as to how Brookson's service can help support you to take advantage of some of the opportunities that we'll be discussing. And as I say, finally, we'll pick up some questions. To introduce myself, my name is Matt Fryer. I'm the Compliance and Tax Manager here at Brookson. I'm a Chartered Tax Advisor at Brookson for 7.5 years now, and my role within Brookson is to ensure the advice and the service that we provide to our customers is accurate, is compliant, is up to date, and is relevant to contractors' needs.
Hi there, my name is Thomas Wynne. I work with Kingsbridge Contractor Insurance, who are the insurance partner of Brookson. Been with Kingsbridge since 2007. We are a specialist insurance broker with a firm focus on the contractor market. We look after the insurance needs of just over 22,000 limited company contractors, freelancers and independent professionals. We have a team of contractor insurance specialists in our Cheltenham office who are on hand to advise contractors of their specific insurance requirements. We've got a number of different bespoke contractor insurance packages for contractors working in IT, oil and gas, banking, finance and such. And Brookson customers do benefit from a discount on our contractor insurance solution, which I'll touch on later on during the presentation.
So, limited company overview. Why would you work as a limited company contractor? I know certainly we've seen it becoming an ever more popular choice. We estimate there's currently around 600,000 contractors working through a limited company in the UK, so it really is a popular choice. I think the first issue is around credibility. So some clients view limited company in a more positive light than engaging with a sole trader. Also, if you're working through a recruitment business, you're likely to be pointed in the direction of a limited company. They don't like to work with sole traders. They'd rather be dealing with an umbrella company or a limited company contractor. Obvious point here, higher take-home pay. So limited company is by far and away the most beneficial way of working for contractors. That is risk-free and compliant. There are other models in the market around offshore structures, EBTs, and they are being slowly closed down by HMRC, who view them as not compliant. So I think limited company does remain a safe and positive way for contractors to work. It offers lower personal financial risk. It's one point that's often overlooked. The company is a separate legal entity to yourself, and therefore any liabilities that arise as a result of the company are wrapped within that corporate structure. So it offers you that personal liability protection. I think one point to bear in mind though is if you are personally negligent for any work you do, you are potentially still at risk, and this is where the need for insurance comes in, which Thomas will talk through later on. And finally, and we'll look at these in more detail later, is there's lots and lots of tax planning opportunities available for limited company contractors, which I'll move on to now. So I think the first thing to think about is how best to pay yourself in a tax efficient way. You own and run a limited company, you're likely to be the director and the shareholder of that company. And because you're wearing two hats there, that gives you various different routes to draw out profits. So the first step that I always think around is making sure you're taking a director's fee. A director's fee is akin to a salary. It's taxed the same as a salary, and it's your company paying you for you being a director. You can pay yourself as little or as much as you like. We would recommend the amounts that you can see on the slide here. And there's various factors which allow us to come to these numbers. So the factors we consider are making sure that you're paying yourself enough to ensure that you're getting credits towards your state pension, but making sure that you're not paying too much in terms of director's fee to trigger national insurance and personal income tax liabilities. And the fourth thing to throw in the mix there is the director's fee is deductible for tax within the company. So if you're paying a director's fee in this current year of £204 a week, which equates to £10,600 a year, you'll pay no tax in the company on that amount. You'll pay no personal tax on that amount because it's within your personal allowance. You'll be contributing towards your state pension, and there'll be very little national insurance to pay. From next year, the figures change a little bit. Obviously, every year we get new tax rates and allowances. There's a change to national insurance, which results in those two revised figures we've got there for 16-17. So once you've considered your director's fee, the next thing to think about is reimbursed expenses. So if you're paying for business costs personally, and they do relate to your business, then your company can reimburse you those tax-free. Again, tax deductible for the company, so saving on corporation tax, and no personal income tax when you receive them. I've got a separate slide shortly around common types of expenses, which we'll talk about later on in the webinar. Next section is dividends. So I think we talked earlier around the benefits from a tax and national insurance perspective that working as a limited company contractor provides you with. You do need to remember that you are you've got certain directors' responsibilities to uphold. And one of them is making sure that you run the company in a profitable way. And the main issue to think about there is ensuring the company has got sufficient funds in it to pay its corporation tax liabilities, and if it's VAT registered, to pay its VAT bills as well. So I think the key point here is to make sure that you're aware of how much profit your company has made as you go throughout the year, because that will tell you how much is available to take out as a dividend, and ensure you're keeping enough money in the company to satisfy its tax liabilities. Once you know that figure, then the amount that you take out can be driven by the tax implications of doing that. So if you're a basic rate taxpayer, so your income is below around £42,000, then you can take dividends out of that company and pay no personal tax on them. In the current tax year, any dividends you take over the higher rate threshold will trigger a 25% tax charge. And there is some planning you can do around that, which again we'll touch on shortly. Next year, so the 6th of April, sees a change to the way that dividends are taxed with the introduction of a new dividend tax. And essentially there's been a tax hike of 7.5% on all dividends that you receive in excess of £5,000 a year. So despite the current government in their manifesto pre the election saying they were not going to increase income tax and national insurance. Well, technically they haven't done that. They've simply introduced a new tax, the dividend tax. And the next slide looks at how that could impact your take-home pay from next year. But before we move on to that, I just wanted to mention directors' loans. If you are in need of short-term personal funds and are considering drawing money out of your company as a loan, just be aware that there are some tax implications. It could lead to some corporation tax liabilities. It can lead to national insurance charges as well. So I just wanted to flag that as something to be wary of if you are thinking about taking a loan from your company. So this slide just summarises the financial implications of the new dividend tax, and we can see here if you are withdrawing a company profit as a dividend, £30,000, you'll see a reduction in take-home pay of around £1,000 from next year. So that's the implications of the new dividend tax. I think it will result in more contractors thinking around tax efficiency, which we'll discuss next. I just wanted to put a comparator table in there as well, just to alleviate any concerns that limited company is no longer a good way to work from a financial perspective. Still offers significant tax savings over working through an umbrella company. I think one simple tax planning point here is to accelerate dividends into the current tax year. If you leave them till after 6th of April, you'll be paying 7.5% more tax on them, so it makes sense to draw them this year. One point to bear in mind though is if you are a basic rate taxpayer, just keep an eye on that higher rate tax band to make sure you're not inadvertently pushing yourself into a higher tax band. So the next few slides will focus on some of these planning points. I just wanted to flag a point I've made previously again, which is around visibility on your business performance. To make the most of these tax planning opportunities, you really do need to know how much you have in your company available to take out. And having real-time visibility on your business performance allows you to do that. It allows you to get ahead of the curve and put planning in place early on in the tax year rather than waiting to the end of the year, submitting your shoebox of receipts and invoices and being hit with a tax bill that you didn't see coming. So you really need to be thinking around the bookkeeping and the accounting support that allows you to do that. So I think I'll spend a little bit of time on expenses. I know certainly from our customers, it's by far and away the biggest topic that we receive queries around. What can I claim? So going right back to the tax legislation, the key rule here is an expense needs to be incurred wholly exclusively and necessarily for business purposes to qualify for tax relief. And what I mean by that is the revenue talk about duality of purpose. If there's an element of private use to an expense, or it could be argued that there is private use, you may get into issues if HMRC looked into your affairs. So the general rule of thumb, if you have to incur that cost to run your business, should be allowable. The example the revenue use though is, you may argue that you have to have a watch for work. Obviously you have to dress appropriately for work, but there's clearly an element of private use in there. So the revenue typically won't allow clothing or watches because, by very nature you need to be wearing those. So I think they do have an exemption around uniforms, but just bear in mind the duality of purpose point. I guess another way to explain that would be for business trips. If you're travelling away from home, potentially need to go abroad for a business trip, and you choose to extend that for a couple of weeks and take the family with you, you may be tainting that business trip and moving it into a personal trip with a bit of business tagged on the end. So just be mindful of that concept. So moving into some specific examples, I think the most popular expense that limited company contractors are incurring are travelling to and from where they work. And as long as you're travelling to a work site which you don't intend to be at for more than 24 months, then any travel costs, any food, any accommodation costs that are incurred on that business trip are allowable for tax purposes. I think the intention point is one worth dwelling on. If you have an 18-month contract, then clearly there's no intent to be in a work site for more than 24 months. If, however, in month 17 you're offered a 12-month contract extension and you accept that, then you're going to breach the 24-month rule, and it's from month 17 when you agree to that extension that your workplace ceases to be a temporary workplace and becomes a permanent workplace, so you can't claim your expenses. So perhaps something to consider when you're looking at contract extensions. Professional subscriptions is another common one. HMRC publish a list on their website, list 3 they call it, and it lists all the professions that they're comfortable any cost for subscription will qualify for tax relief. I think if your subscription doesn't appear on that list, your accountant should be able to guide you as to whether it's tax deductible. But again, jump back to the general rule: do you need that professional qualification to carry on trading? It's likely that you will, in which case it's likely that you'll get tax relief on it. Professional training is also another one. If the training is for the furtherance of the trade, to maintain your CPD requirements or to refresh your knowledge, then absolutely fine, you will receive tax relief on that. If the training is to almost retrain yourself with a new skill or set up a new business or new trade, HMRC will often look to deny tax relief on that because it doesn't relate to a current trade. So just a slight distinction to bear in mind there. Obviously any accountancy costs of insurance provision are tax deductible, so there's 20% corporation tax relief on those costs. Some less common examples, but
Well, if I can just interject there before you move on to the less common ones. I've got a couple of good questions coming, which feels worth taking at this point. I've got a question from David, who's asked, how far away does my work site need to be to restart the clock on the 24-month rule?
Yeah, good question, David. I think that unfortunately there's no clear rules around this, so we need to look at HMRC guidance and case law, and certainly from our experience, we know the revenue consider whether there has been a significant change to the nature of your journey. So that's their starting position. And evidence they'll look towards will be the costs incurred in the journey, the mode of transport, obviously the duration is important, but when they're looking at duration, they're thinking about the whole journey, not just the change in the journey. So I guess an example of that would be if you are living in Cornwall, working in Aberdeen, and your new work site is 5 miles the other side of Aberdeen, but you're still living in Cornwall. I think HMRC's view will be there hasn't been a significant change to your journey there when taken as a whole. If, however, you only live 5 miles from your current work site and your new work site is 2 miles away in the opposite direction, then even though it's only 2 miles away, when you look at the journey as a whole, I think that would be classed as significant. So there is some judgment involved here. It's a bit of a grey area, but I think just think, has there been a significant change, or could I prove to HMRC if challenged there's been a significant change to the nature of my journey? And again, if you're in doubt, you should be looking to your accountant for some advice and guidance on that.
Thanks, Matt. And a question from John, who says he spends a lot of time working from home. What else can he claim on expenses relating to that?
Yeah, okay. So working from home, there's two ways to go about this, I guess. HMRC will allow £4 a week as an amount you can claim tax relief on. It doesn't sound a great deal, but I guess it does add up. And that's a relatively safe way of claiming tax relief on home working expenditure. The other way you could do it is to think about a proportion of the household running costs. So if you have a house that's got 8 rooms, you use one mainly for business purposes, there's an argument to say 1/8 of all of my household bills should be allowable for tax purposes. I think if you're thinking of doing that, you need really strong evidence. You're going to need to keep all your receipts and invoices, and you're also likely to have to prove to HMRC that it is a requirement that you work from home. So you couldn't fulfil the role if you didn't work from home. So I think when we discuss this with our customers, most people say, well, I know it's only £4 a week, but it's a safe option, I'll go down that route. I guess the other thing to mention is if you're thinking around claiming proportions of household costs, there can be business rate implications, there can be capital gains tax implications. The CGT implication is around the tax exemption you get on your main residence. So if you sell your main house, there's no capital gains tax, unless there's been an element of business use. So you could end up having capital gains tax arising on the sale of your property. So again, I think most people are, when they look at it, are comfortable just to claim the £4 a week.
And sorry, one more. As we expected, sort of inundated on expenses. This always seems to be the case. Just got a question from James Davidson, who's asked, how far away from your workplace do you need to be before you can claim accommodation costs?
Yeah, good question, James. Again, I think as long as your trip is a qualifying business trip, so you're attending somewhere for less than 24 months, then you can claim accommodation costs. So that there's no fixed rule on this. I think the only thing to be mindful of is if you are living in accommodation that you're claiming is for business purposes and temporary accommodation, if you end up moving your possessions there and it becomes your permanent place where you live, I just be careful around that kicking in. But yeah, if you need to work 20, 30 miles away from work and it's more convenient because of transport routes for you to stay in a hotel, then that's absolutely fine.
We'll just take the last one on expenses before we move on. A question from Tom Kelly, who's asked around if he's purchasing and incurring expenses that he's paying for by cash rather than paying from a business bank account. Is it okay still to declare them as company expenses? So things like parking would be a good example there, Matt, I think.
Yeah, absolutely. So this was the reimbursed expense point I mentioned earlier. If you're paying for what are really business expenses out of your personal cash, then my advice would be to keep hold of the receipt and ensure your accountant is aware that you've incurred that expense. They may ask for the receipt, but certainly keep hold of it for evidence. Then your company can reimburse you that amount tax-free, and that's quite common, certainly in our client base. So absolutely no issue with that. Okay, just finish off expenses perhaps with the company car question. So this one is becoming a more and more popular question within our client base. Can I have a company car? What are the benefits of that? So you can claim tax relief on within your company if it buys a vehicle for you to use for business purposes. I think it's back to the duality of purpose point though. HMRC's view is that if there is any private use, and I have spoken with some inspectors who take the view that even if it is available for private use, then they'll look to trigger a benefit in kind charge, which can have income tax and national insurance implications. So when we crunch the numbers, which we're being asked to do more and more, we quite often come out with a result that if the car has got very low CO2 emissions, it can work out beneficial to buy it within the company. Also, there's a concession for company vans as well, where the benefit in kind charge is quite low. If, however, the car has got medium to high CO2 emissions, it's often more beneficial to own it personally and claim the 45 pence a mile fuel claim for attendance at a temporary work site. So just an overview on some of the other common tax planning opportunities available to you. I think one of the more popular choices is appointing a second shareholder. So if your company is profitable and you've got money in there, which if you took out would take you above the higher rate tax threshold. So if you take in excess of £42,000 out of your company each year, then any dividends that fall within the higher rate tax band, currently you're going to lose 25% of them in income tax. From next year it's 32.5% because of the new dividend tax rate. So you would look to a second shareholder, and you can pay profits out to them. So shareholders are entitled to receive dividends. If the second shareholder is a basic rate taxpayer, they're going to be paying a lower rate of tax than you are. the revenue have tried to attack this in previous years. I think there was some draft legislation published 5 or 6 years ago around income shifting. That draft legislation has been shelved. We've seen no evidence. We haven't heard anything around the revenue looking at this again. So if done correctly, it is a relatively safe piece of tax planning, and it's a very, very common piece of tax planning. I think the key points to remember here are that the second shareholder ideally should be a spouse or civil partner, because they qualify for an automatic tax exemption. If they're not, it gets more difficult in that you need to evidence that they are contributing to the business. Also, the shares need to be more than a right just to income. So that means often the second shareholder is entitled to return of capital on the winding up of a company. And you can get into issues there if there's separation or divorce. So just something to bear in mind before you implement that. Again, I think it's worth seeking advice if you're thinking of having a second shareholder. Pensions, tax efficient deferral really. It's a good way to save for retirement. There's tax relief on contributions made into a pension, whether they're made personally or you can make them directly from your company if the company sets up a pension scheme for you. But obviously there's tax when you take money out of the pension after retirement. So that's why I refer to it as a deferral. But I think if you're a higher rate taxpayer now and you'll be a basic rate taxpayer when you retire, there's tax savings to be had, albeit you need to wait a number of years to benefit from them. Very briefly, flat rate VAT, bit of a no-brainer this one. If your customers are VAT registered, you can voluntarily register for VAT even if you're below the VAT registration threshold and fall within the flat rate VAT scheme. This means that you pay a lower amount of VAT over to HMRC than the amount you collect from your customers. You do forfeit the right to claim expenses, VAT back on your expenses, but typically contractors have high turnover, low expenses, so you can make money out of this. Final one to mention is capital distribution.
Just before you do that, Mark, just a question on flat rate VAT from Janice, who asks, can the flat rate VAT scheme be used at any point in the lifetime of a limited company?
It can. So you can register for the flat rate VAT as soon as you set up your business. If you've been trading for a number of years, you can register, and there are opportunities to backdate that registration. But again, I would be speaking to your accountant just to make sure that's done correctly. Final one I was going to mention was capital distribution. This is a tax planning opportunity for people who are thinking of winding down the company, closing it for a commercial reason such as retirement, emigration. If you've got a permanent role lined up and you don't need your company anymore, you can take out any accumulated profits at 10%. Which obviously is a lower rate of tax than you pay on dividends. This is becoming ever more popular with contractors. HMRC are aware of people abusing this, so people running a company for a few years, closing it down, claiming the low rate of tax and then setting up again. So from April this year there's going to be a change to legislation which will say if you commence a similar trade within 2 years of finishing the previous one, then this opportunity will be withdrawn from you. So really it is something that I think is of benefit to contractors who are looking to retire. And certainly if you start planning 3 or 4 years in advance, you can start to accumulate funds within your company and get them out at a very low tax rate on retirement. So that's a whistle stop through the main tax planning areas. I'm going to hand over to Thomas now to discuss insurance.
Thank you very much. So I think the top caption hopefully sums up contracting very well in terms of there's a hell of a lot of benefits, but there are also some risks. I think I'll talk very briefly today on just how to manage those risks, and hopefully insurance in some way negates those. So top point we've got here is that having insurance is often a contractual requirement. The agency that you're being placed through or the end client that you're working for is likely to stipulate within the contract terms that you will hold some type of insurance. You'll tend to see reference to professional indemnity, public liability, and often employer's liability, even if you are working on a contract basis. Even if this isn't asked of you by your recruitment consultant, it's important to check the terms and ensure that if it states a requirement that you've got it in place. Number two, the point that having insurance is an IR35 indicator. It certainly makes your business more credible. I think a key differentiator from being an employee to running your own limited company is that requirement for insurance. As a contractor, you ultimately become responsible for the advice that you give and the work that you're completing and your general actions. And hopefully having that insurance helps to demonstrate that you're acting as a legitimate bona fide business in your own right, that you're taking commercial risk and you're taking financial responsibility. Point three, just protecting yourself, I think, is the real key message. It's important that you're protecting yourself should a claim be made against you, because even if you're not at fault, it's often costly and time consuming to defend yourself. The insurance that Kingsbridge provide will cover all of the legal defence costs involved in defending yourself, regardless of whether you're at blame. I think there's a real misconception in the market as well as to the kind of the cost and the indicative premiums that you're likely to pay as a contractor for insurance. I think it's fair to say that if you go to a general insurance broker on the high street and you reference your job role in engineering, for example, that you're a limited company, and your earnings, there's often some confusion as to the role, there's misunderstandings as to the associated risk, and you may well see an inflated premium. It's important, just like the Brookson model, dealing with a specialist accountant in Brookson's case and dealing with a specialist insurance broker that really understands the risk that you face. 90% of Kingsbridge's customers pay less than £450 for the year. That's an annual premium. You can pay it monthly to make it slightly more manageable. Importantly, it's a tax-deductible business expense as well. So once it goes through the business, you should see a 20% reduction there as well. Make sure that you're flagging that with your accountant, because we do see cases where you may well be paying that personally, and then this isn't being factored in, and you won't benefit from that saving. It's also worth noting that the Brookson clients do get a discount on the Kingsbridge policy, so discuss this with Kingsbridge or with Brookson as and when you talk to either business. So I think the point around having the responsibility to protect your business, but also the businesses you're working with, to me it's important that you're fully protected as a director of the business, but also that you're in line with your contract terms, that the end client and the recruitment agency are seeing you as a compliant professional contractor. That to me is pretty imperative. For those of you that are on the webinar that currently don't have insurance in place, that didn't buy it when you started the limited company historically, or haven't been specifically asked for it by your recruitment company, I would certainly say consider it, have a look at whether there is a requirement in the contract. And importantly, I just flag that the moment you're insured with Kingsbridge, the moment you take out insurance with us, you're actually insured for your last 6 years worth of risk. So if a claim were to come in for advice you've given or work you've completed in the 6 years previous, as long as you weren't aware or aren't aware of an impending claim at the point where you purchased insurance, Kingsbridge would cover that cost of any claim that came in. So types of cover, the three main ones, or the three most beneficial I've flagged down here. Professional indemnity to me is absolutely critical. All businesses in the UK business landscape insure the product that they're selling. Now, in a contractor's case, that might be the design work that they're completing, the advice that they're giving, the work that they're completing on the project. I think in a contractor's case, it's often their expertise, their knowledge base, and their advice, and it's imperative that you're ensuring that if that's the work that you're undertaking. So professional indemnity covers the advice that you give, the work that you complete. It covers any claims of errors, omissions, or negligence, and that is the one that most recruiters will be very, very stringent on. Public liability is possibly the second most important. That covers when you're on site or if you're in an office for any actions that you make or take that lead to third-party property being damaged or third-party persons being injured. So if your actions result in somebody being injured or something being damaged, then the public liability policy would pay out. So one of the risks, I guess, of contracting away from full-time employment is that as an employee, if you're injured and couldn't work, then you'd like to think that your own client would, or your employer at that point, would look after you and would continue to pay out your salary. In contracting, this isn't the case, and being injured or having an injury can lead to loss of contract and loss of earnings. With the Kingsbridge standard policy, all of our 22,000 clients are also insured for personal accident, disablement and death. So if you were injured in your way to and from work in a car, or at any point worldwide in your professional capacity and you were unable to work, the Kingsbridge policy would pay you £2,000 a month for 12 months to help plug that income gap, I guess, which will hopefully help to pay the supermarket bills and pay the mortgage. So one thing I've flagged here, having spoken to Matt earlier, is block policy consideration.
Tom, could I just raise a couple of questions at this point before you cover block policy?
You may.
A couple of questions coming around common claims, so one in particular from Donald. Can you provide some examples of the types of claims that you're seeing on a regular basis?
Yeah, absolutely. Regular PI claims we see, PI covering the advice you're giving but the work that you're completing. Regular claims we've seen recently, more and more so, especially from the IT world, is loss of documents or loss of data, breach of confidentiality, anything leading to a reputational damage for an end client. I think data is becoming more and more important, and it's somewhere where we're seeing more and more claims. We had a sizable PI claim earlier in the year from a surveyor who used the wrong metric scale when setting out. That led to a delay in the project and a reasonably high cost to rectify that. So professional indemnity claims, there's a couple of examples. Personal accident, unfortunately, Kingsbridge have had a number of injuries to our contracted client base, whether that's been in motor incidents or otherwise when they've been on site. Public liability, we had one of note in 2014 where a contractor that we insured unfortunately hit someone else on site with their vehicle, and that led to injury of an individual but also damage to third-party property, and it was the actions of one of our contractors. So claims do come in all shapes and sizes, and I think the key is if you've got the insurance for a really low annual cost that, like the Kingsbridge solution, then hopefully this isn't something that you need to worry about, and you can ensure that you're contracting and in your professional capacity confident that somebody will step in if something were to go wrong.
Thanks, Tom. I've got one more. I think you've covered this already. It's a question from Tony around if my agency hasn't asked for insurance, do I still need it? I think you covered this around devil in the detail of contracts. Yeah. Is that the case?
Yeah, absolutely. So whilst your consultant may not have asked for it either at the start of the contract or more recently, I would always check the contract that you have signed with that business, because just purely because a consultant hasn't requested it, I would say almost exclusively there will be an explicit requirement for insurance in some way. Regardless, if a claim were to come down from an end client to you, to me it's imperative that you're protected. It's important that you're operating as a business from an R35 perspective, and really that you're protecting yourself. So just simply because a recruiter hasn't asked for it, I would say check the contract and think how you want to be operating in your limited company and business, and make sure that you're operating in a way that you're comfortable.
Okay, thanks, Thomas. So moving on to IR35, I know we've had a few questions in around this. It is quite a hot topic at the moment, and I think over and above the insurance issues that Tom's been talking about, IR35 probably is one of the biggest risk management issues that limited company contractors face. The risk can be managed, and I think we are seeing HMRC becoming more and more proactive around enforcement of IR35. The last 2 or 3 years have seen various reviews of IR35. There was a proposal to get rid of it a few years ago. It was decided that we should keep it. HMRC have ramped up enforcement activity. I'm aware that they've got 4 specialist units now across the country with IR35 specialist inspectors. So we, certainly within our customer base, we've seen an increase in the number of IR35 enquiries being instigated over the last 2 or 3 years. Now, It's gone from 2 or 3 a year out of our 12,000 customers up to 9 or 10 a year. So you're still going to be unlucky to be selected for an inquiry. And based on analysis we've done, there doesn't seem to be any indicating factor to put you at higher risk than anybody else. It's entirely random. But if you are selected, it's important that you have considered your position. So, our advice would be to make sure that you are receiving contract reviews and you're receiving working practices reviews. Certainly at the start of every new assignment, and if the assignment goes on beyond 6 months, it's well worthwhile getting the position checked again. In our experience, if you've had a review and there is some independent evidence you can provide to HMRC that someone, a specialist, has considered your position and thinks you're outside the scope, quite often inquiries can be closed down pretty quickly. So there is real benefit in making sure you're having your position checked by a specialist. I just wanted to touch on IR35 friendly contracts. I think historically some people have taken the view that if the contract has a substitution clause in there, if it's got an end date in there, if there's nothing in the contract around control, then you're home and dry from an IR35 perspective. And certainly historically that may have been the case. Our experience now is HMRC really want to get into the detail of the day-to-day working practices. I wouldn't say the contract is irrelevant. It's now one of 2 key issues. So, by all means make sure the contract is reviewed. But I think the most important thing is it reflects reality. So it's drilling into your working practices, how you're managed, how you're controlled. These are the key things that the revenue is starting to look at. And I think that may indicate where we may potentially be going with IR35. Last summer there was a discussion document published by HMRC and they wanted evidence around is this working, are there things we could do better. I know they received lots and lots of responses to that and they are still considering the views of respondents. I would expect there to be an update on the 16th of March in the budget. Brookson will be issuing a view on what has been announced in the budget, so keep an eye out for that. And I think we will potentially move into a more formal consultation stage. So HMRC may propose their new IR35 and then it will be open to the contracting community to consider that and responding with views to HMRC. One potential route they could go down is focusing the test solely around control. So are you controlled in how you do your job? And that could be the one test that they start to look at in determining IR35. The other thing that I know HMRC were keen to do was to transfer liability to the end client. Obviously we have a concern with that because end clients' attitude to risk may result in some end clients no longer wanting to work with contractors because they don't want to take the risk. I know CBI have got very strong views on this and they're very firmly opposed to that option. But I think wait till the 16th of March and we'll know much more. I think it's worth touching on the final slide around Brookson services. So we offer an all-inclusive accountancy service designed specifically for contractors. If you're on the webinar and you're not already a limited company and are considering whether that's going to be beneficial to you, by all means speak to us. We offer free consultations to discuss the choices available. If you're with a current accountant and you're not happy with the service or you want to try Brookson out, we can help you switch. I think our service really is, or limited companies in general are suitable for career contractors earning in excess of £15 an hour, and that's just a benchmark to make sure that you're not going to automatically fall foul of IR35. Our service is relatively unique in the market in that we offer real-time updates showing you how profitable your business is, how much you can take out, and you don't have to fill in spreadsheets to do that. We manage that through our online portal. We offer unlimited IR35 reviews as part of our standard service. You can have as many as you like. As I say, we recommend certainly on commencement of a new assignment and every 6 months thereafter. We'll stand by our opinion. If we think you're outside of IR35, we'll deal with HMRC's inquiry and we'll back that opinion up. There's no hidden cost with the service. Personal tax returns are included. Basically all your company and personal returns are covered. And we have in-house tax specialists, in-house financial services teams. We have an in-house legal service team who can help with employment law advice, more recently looking at wills and probate. And obviously we work very closely with Thomas and Kingsbridge for insurance provision.
Okay, thanks, Matt. We've had lots of questions come in. I think, as I said at the start, we will at some point run out of time and won't get round to answering them all, but we will look to do an FAQ style document to sort of address any questions that people have submitted, and we'll make those available to all the attendees today. I suppose that just leaves me to sort of thank everyone for joining us today. This completes the webinar, and I hope you've found it of interest. The only other thing I would ask is if you would kindly take a moment to provide us with some feedback by completing a very brief survey, which you'll see shortly, come on your screens after the webinar has finished. Just thank you again on behalf of Tom, Matt and myself from the teams at Brookson and Kingsbridge